We've just had the Easter break, but I suppose all eyes now on Janet Yellen's speech, the Federal Reserve Governor in the US. And really, it's about clues for the timing of interest rates, isn't it?
Yeah, so I mean, if you're looking at the timing of interest rates, I mean, what really helps us almost understand it is the federal funds futures. Yeah. And now that you can really get an indication of when the US is going to hike interest rates according to the markets. Up until the FOMC meeting that we've recently had, we were looking at probably four rate hikes coming out of the Fed, but the market was only pricing in one to two rate hikes. So obviously after the FOMC and with the Federal Reserve coming out and saying perhaps we're not going to have as steep a rate hiking cycle. I mean, they do that via the dot plot. I think the markets really breathed a sigh of relief just before Easter. Yeah. Now, what the markets are looking for this afternoon in Yellen's speech is just an indication of how the Fed is thinking about the US economy, how the Fed is thinking about that path of the US interest rate liftoff. From our point of view, I think we're still looking at probably one more 25 basis point hike this year, yeah. and even that with the likelihood that that's probably going to be either September or December.
We were talking during the break about, just broadly speaking, this United States economy. It's the world's biggest economy, and we know generally what happens. Investors are looking at the world's biggest economy because it relates to everyone. Where is the economy at the moment, and is there a trajectory, a definitive one?
Yeah, I think it depends, I suppose, over the period that you're looking. But if you look at post-2008, so that's really what I think most market participants would be interested in. I mean, you've seen, obviously a huge amount of very unconventional monetary policy tools being used. And the result of that has actually been overwhelmingly positive for the US economy. So what you have seen is, I mean, the US labor market's basically returned to almost a frictional unemployment level. You've seen unemployment, come down fairly dramatically. And I mean, we're going to get non-farm payrolls numbers out on Friday as well. So we will get further insight into the US labor market. But what the criticism has really been is whether the participation rate in the market has been high enough. Are these actual jobs being created, or are these people that are dropping out of the workforce because they're no longer looking for work? Now that, but from all indications, I mean, we can look at sort of every hourly wage almost as an indication, and seeing those wages starting to increase, you're starting to see, inflation pressures coming through from the US, which for me is an incredibly positive sign. It means that people are employed, people are working, and the economy is getting stronger. It also justifies the single rate hike that we've had so far. So from my point of view, I think you can see it also in the stronger dollar, but the US is on solid footing. I think far better footing than somewhere like Europe.
The other place that investors have their eyes on is this oil price. Now we see it just below $40 a barrel. Just given the international scenario at the moment, I mean, where do you think this oil price is going? I would imagine it's going to stand around this area for some time to come.
Yeah, I mean, commodity price is always very, very difficult to predict. Our feeling is that you are going to still have a very subdued oil price. I mean, we believe the stronger dollar trend is going to continue, and that definitely is going to help keep a lid on oil returning to, say, $80 a barrel. Yeah. On top of it, if you look at the supply and demand dynamics within the oil markets, I mean, obviously we've had a breakdown of the OPEC cartel. I mean, we've had Russia and Saudi Arabia trying to almost freeze output at those January levels, and there has been discussions. But with sanctions being removed from Iran, and Iran really saying that they want to ramp up production to sort of pre-2008 levels, there's still a huge scope for Iran to continue to pump oil, and that for us should keep the supply side of the equation fairly robust. So, I mean, that will keep prices suppressed. Looking at the demand side, though, I mean, we've seen in China, I mean, when oil prices initially fell, I mean, China really, increased buying, into their strategic petroleum reserve, and you're just not seeing the demand coming through from China. Add to that the US inventory buildup that we saw last week, and that really unsettles, I suppose, oil market traders. And I mean, you can understand why that has just had that little pullback from that $40 a barrel level.
All right, I want to bring it back home, talk about the rand for a moment here. 15.50 against the US dollar. I see statistical economist John Maynard really scrutinizing this entire issue about whether or not rand weakness is good for manufacturers here in South Africa. That's been a narrative on one end for a long, long time. And he says, no, it actually isn't. Just given what we've seen with the weak exchange rate, he says it rather hurts the economy more than anything else. I mean, where do you stand with this narrative?
Yeah, it's always very difficult because, I mean, if you look at an economy overall, I mean, and you're trying to relate an interest rate to how an economy is going to react. And an economy is a complex and very adaptive system. Yep. So, to make, broad sweeping predictions is very, very difficult, far more difficult on an economy than if we were trying to predict the direction of a company or a company share price. Now, looking at it, for us, it's far more important to have a stable currency because that helps companies plan, etc. I mean, I read the report that you're referring to. I mean, they're saying it cost, I think it's 150 billion rand over the last 6 years, so fairly significant. But if you look at it, maybe if you take like a gold mining company as an example, you can see that the weaker exchange rate in the short term really has boosted these gold mining companies enormously because the rand price of their product suddenly becomes very attractive. In real terms, in dollar terms, wages become very suppressed, and that already assists. I suppose the company's balance sheet, it increases the margins, and you're seeing these huge benefits as suddenly they're producing at this. I mean, their costs are at that level. They're at least the price they're getting for the metal is in rand terms is at that level. But the problem comes then further down the line when those companies they benefit in the short term, but longer term when they have to buy new capital equipment and they have to import that.
Overseas purchases.
It's incredibly difficult. So I think for us, weak rand versus strong rand debate, it's difficult. I mean, different sectors will benefit, but for us, we're really looking for a stable exchange rate.
We'll leave it there. Gary Booysen from Rand Swiss, thanks very much indeed for the perspective. Now we'll take a look at more business news coming up after